Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined yet again by technical strategist Todd Sohn to talk all things markets. Todd, how are you doing today?
Hey Ross, I'm well, and it's always a pleasure to speak with you. We highly enjoy these.
It's great to have you back. We really enjoy the insights, and we're getting you at a good moment because yesterday was a big market move. We're recording this on Thursday, so a big move higher in the equity markets following a softer than expected inflation report. That seems to be, the market's one track mind right now is inflation. But I want to know, what did you make of the move, and was there anything under the surface that you all were watching that kind of struck your attention?
Yeah, the response to the better than expected report was strong from the equity market. You had a very good trend reading, which reflects volume into advancing stocks. One of the better signals we've seen in some time. That reflects very good buying demand internally. Now, the move has left about 84% or so of stocks above their 50-day moving average. That's just shy of the 90% threshold we look for to help confirm that this is a major market move that's occurring. Of course, there'll be some pushback and ebb and flow along the way, but all major market lows over the last 70 years have been accompanied by greater than 90% of stocks above their 50-day average occurring coming off of that low. So we'll continue to watch that data point every day, particularly as the S&P heads into the teeth of resistance here into the 43 to 43.30 area. Again, it remains a day-to-day assessment, but so far the response to yesterday's report has been solid.
That's important, right? Like you said, the breadth off the lows is one of the things that I know you all look for. More than just the headline move, especially as market concentration kind of ramps back up at the top. So let's zoom in a bit and look at some other signals at the sector level that might confirm or give you pause on whether this is a major market move. And I think the best way to frame this up is industrials versus consumer discretionary. Both are pretty cyclical sectors. You think about machinery, airlines, freight, and then the consumer side of things, which reflects whether the consumer is out and spending and how they feel. They're kind of sending different signals. So could you talk through those two sectors and the takeaway from all of that?
Yeah, absolutely. And it's a great question. You always want to see this risk-seeking appetite, this economic cyclicality coming off of major lows. The industrials have had a nice improvement here. They've kind of been off the playing field for much of the last year. So you're seeing defense names, machinery, as you mentioned, acting a little bit better. But there's been some holes, though, in this rally, in that discretionary leadership has been a little lethargic, rather relative to the market, and consumer staples, too. So that's a bit of a hole. And I also want to point out the semiconductor stocks have had a bit of a rough week as well, post the news from some of the companies in that index. And so, yes, industrials are supportive here from a risk-seeking appetite, but we still want to see discretionary act better. We still want to see semiconductors act better for a full composite of economically sensitive groups leading here off the low. You never really like to see stocks break out with more defensive leadership. It says to us that there's some skirmish here in terms of risk appetite.
Right. So in the first question, we're at 84%. You want to see 90 here. There's a couple sectors, but you need to see more. So it's painting a picture of we're on the way there. We're almost there, but not quite there yet. And so we need to see the data confirm that. One other place that you all do a lot of great work is flows in and out of ETFs. So it's kind of the idea of investors voting with their dollars on where they want to be. And so I'm just going to turn it over to you. You monitor this daily. What are you seeing from ETF flows, and what is that telling you about investor sentiment and how folks are feeling at this point, a month plus into this rally off the lows?
Yeah, so what's really interesting to us is that since the 10-year yield peaked in June 14th, about 2 months ago, there's been a role reversal. You've seen all the beaten down corners rally, whether it's crypto or non-profitable tech, while leadership names such as energy and materials and whatnot have taken the back seat here. And that's being reflected in the flow data. Flows to growth ETFs, whether large cap, small cap, more thematic, have started to surge here. So I think there's a bit of chasing going on, and that folks maybe haven't had the exposure they want to some of these growthier areas of the market. And so that always leaves us a little hesitant that perhaps sentiment is getting a little aggressive. I would not call the flows historically extreme like we've seen into some corners, perhaps such as treasuries. But just keeping in mind here, as the market rallies into sharper resistance, that sentiment is getting more and more aggressive. And nothing changes sentiment like these price rallies. But again, keep that in mind. It's a similar scenario with high yield. High yield flows have really been off our radar for much of the year until the last few weeks. You're getting appetite coming back into the bond market. But again, you don't want to see it get too aggressive, pairing that off with the growth flows that the sentiment picture is starting to get a little one-sided here. And that leaves the market, especially a very overbought market, prone to some form of a pullback.
Well, I think this is all painting a great picture to kind of take stock of where we are. Again, a rally off the lows, some really optimistic data points, but still reason for caution out there. And so reason to tread carefully. So Todd, thanks so much for the time and the insight. We always appreciate it. And we'll look forward to having you on again soon.
Likewise, Ross. Thanks again for the time.